Hello, Yahoo Finance. Hey, Ross Mack. Hope all is well. This is 𝐶𝐨𝐧'𝐭, also known as Wall Street Consortium on IG. With so much going on right now and so many people who've been in the Mag 7 for over 10, 15, 20 years and seeing their portfolios going down and in red, what would be your advice to them as far as a flight to safety for a period of time while things start to settle down eventually? You don't want to miss the run up. I do understand that because I do believe that technology is definitely the biggest place for growth. But for those who are panicking right now and looking for places to put money, where would you tell them? And is there a percentage breakdown that you would have them do? Is it 80-20, 70-30, 60-40? Just looking for your opinion. Thanks again and have a great day.
I love the question, right? To the audience, first, let's define what the Magnificent Seven is, right? That's Facebook, Apple, Amazon, Microsoft, Google, Tesla, and NVIDIA. Over the past 10 years, like you said, they've been going nuts, been going crazy in a good way, meaning that these have been some of the highest performing stocks. And so now, fast forward to today, anytime there is any chaos in the market, anytime there is any volatility, you have these names that effectively, are extreme. Well, tech sector as a whole do extremely well when the market is green, the economy is going well, but they also are first to get sold when, there is volatility and uncertainty in the market. And so I love the question. And I think the way you look at this is saying, right, you have to assess what your investment horizon is as well as what your risk tolerance is. Clearly, you're extremely risk tolerant because the vast majority of portfolio are in these seven names. And I don't think it's saying I'm going to sell all of them out. I think it's just a function of rebalancing. And what are we rebalancing to? Is it more defensive names? Is it, granted what's going on with, kind of war in the Middle East and Iran, et cetera, and uncertainty? Is it owning energy and oil companies? Or is it owning defense names? Is it owning, kind of more cash flowing businesses? Or is it saying, you know what, let me diversify into ETFs, right? Index funds. And I think that's the way to go. And so if you're looking and you're saying 70, over 70% of my portfolio are in these seven names, maybe the idea is saying, let me rebalance and put something into the overall market. Because when we're talking about these names are down 10, 20, 30% from their highs. Whereas if you look from a year to date standpoint, the S&P 500 is only down roughly 1%, right? So now it's saying, okay, how can I stomach the volatility? The way you stomach the volatility is rebalancing into more diversified investments. And I would start with the S&P 500. Now you could also rebalance into something that is also more tech oriented, that's still giving you that, that exposure, giving you that upside, is the NASDAQ, right? The QQQs to be specific. And so I like the idea of rebalancing. And once again, this is not a one size fits all. This is to this particular individual, because to a new investor, I'm going to tell you have way more of your portfolio in index funds, S&P 500 and the NASDAQ. And then from there, you can start owning single names and maybe it's dividend paying stocks. But I think the idea is rebalancing into more diversified, which will actually help you stomach the loss, and you'll still get some upside on the NASDAQ side as as the market turns and uncertainty is, we kind of remove the uncertainty from the market.